It's Brian Preston, the Money Guy.
Next question is from TJF4700. Hey guys, could you speak to using cash value life insurance as an investment to avoid taxes in the future? I have been seeing a lot of videos about this. So now let's make a video about this.
By the way, do you know why there's a lot of videos about people mentioning cash value life insurance? It always comes around when there's a lot of volatility. It always comes around when the market's scary and things are frightening and fear is on the forefront of all of our minds. Just something to notice, something to kind of put a feather in your cap and think about.
Well, look, there's several things that hit me about this, and I know you have some ability to share because you actually sold life insurance for a period of your life. Life insurance, by the way, we love. We talk about it all the time. We have tons of life insurance now. The difference is we have what's called term life insurance, meaning there's no cash value component. It's only just the insurance coverage. I pay what the insurance costs to protect my family, to replace the income that I'm worried about losing or the debt I'm trying to pay down. And then it's time certain, whether it's 20 years, 30 years, it will come to a close at some point and the insurance just goes away. So it's not uncommon for people in these volatile markets to talk about cash value because there is these unique things where cash value, you contribute, large premium payments, much more than the cost of the insurance because that spread between what the cost of the insurance is and what you're contributing, it really has two components. There's what the transaction costs, the commissions, and all those components. But then the leftover after all the fees and all the hands are paid and pockets are filled is that you get to invest it. And then the government has these unique rules that you can actually take loans from your cash value completely tax-free. Now, it does lower the death benefit that you're going to receive, so you are borrowing from yourself, essentially. And if you borrow too much of the money, you might blow the policy up and actually create a big tax bomb in the future. But here's what I always want to remind people when we reach these volatile periods. When anybody, because this is life insurance you asked about, but I also see this with annuity sales too, because they're all relatives. They're all built on the same tree. They're all sold through fear. In a lot of ways, is that they will say, look, you can't lose with these investments. We guarantee that you can't lose money with this investment. And whenever I hear the word, because anybody who's gone through any type of broker training or anything, you never hear us talk about in investments guarantees, because that is a compliance nightmare. I will tell you historical averages, I'll tell you what's happened in the past, I'll tell you potential, but you never hear me talk about I can guarantee you that the stock market will make 9 to 10%. No, I do not guarantee that it's going to do that for you, because there are risks involved with investing. So how can the insurance company do that? How can they actually, from a compliance standpoint, tell you there has to be a catch for them to be able to offer something of such importance and value to you? And here's what it is. They can control you. They can control your behavior. We showed a slide in last week's show that we did that a 60-40 portfolio every year looks like a scatter plot where it's all over the place. You can't figure out up, down, what's going to happen. But if you spread out your time horizon to 10 years, there hadn't been a 10-year decade, even with the lost decade involved with that of the 2000s, where a 60-40 portfolio lost if you stayed invested that 10-year period. So the insurance company, to give you that guarantee, they will control your behavior. And how do they do that? They will put restrictions to where you can only get access to a very small portion of your money for a lockup period of 7 to 10 years. Well, wait a minute, Brian. You just said there hadn't been a period of time where if you can stay invested for 10 years that you won't lose money. Well, yeah, that's exactly right. You're letting the insurance company control your ability to have access to the money. They could also, by the way, go pay tremendous commissions. There's another reason why TikTok has so many of these is because the person selling you this product is going to make a tremendous commission. If you think about, and Bo, you can correct me on this because I think that first year premium primarily is commission.
That's exactly right.
So whatever you're writing that premium, you're not really writing to the insurance. You are, but it's going to be kind of,
paid out to the guy selling it.
they're going to give
The
you,
person
and then
selling
that
it.
person's going to give it back. And that check, really, they could have just written the check to you, the person selling it, but it went through a few hands before it came back. So that's one of the things that drives it. But the ultimate thing is they control your behavior. The insurance company is going to go do exactly what you could do for yourself and go invest that money. And then because they're restricting you to 7 to 10 years of holding periods, with all these surrender charges and everything else, they're going to go invest that money. And they're going to go make the 9 to 10% historical average. They're going to guarantee you 3, 4, 5, maybe with these interest rates that we are now, maybe it's even getting closer to 5 or 6% because it was really low historically with low interest rate environments. But they're going to keep the spread. So you have to ask yourself, legacy-wise, and maximum opportunity, because the thing that breaks my heart is when somebody has an issue where they have a medical expense, or they have a big opportunity to go buy something that's a chance of a lifetime to invest in, and they can only get access to, 5% of the principal value?
Yeah,
or
early on in the thing, yeah.
I mean, you might be restricted. Your behavior has to be restricted for that very hard threshold of guarantee. Has to have some type of limitation on it.
Even later on in the policy, our stance is we like investments to be investments. We like insurance to be insurance. They do two separate things. They serve two separate purposes. So we think when it comes to making your financial decisions, you ought to operate in that capacity. And one of the things I'd encourage any of you to do, if you have someone trying to sell you insurance, or if you're looking at this, they'll often come show you like an illustration or an in-force illustration. Says, if you do this, you'll have $1 million when you're 60. Say, okay, great. What happens if I want to go buy a $950,000 lake house? And just see what the answer is. Just see how they answer the question and what the answer is and where it goes from there. I don't love things where I have to borrow my own money from myself to get access to my capital. So make sure you understand that before you go into one of these types of products.
Last thing that I think about, just band of life. When you're in the messy middle, there are so many things pulling at your back pocket, because that's why we came up with the financial order of operations, is because I want you to know what to do with your next dollar. And it panics me that if you're sending, $1,000 a month, because that's the other thing is I think I'm basing this off of the last time we did a show. I think permanent insurance, like whole life, has a factor of 25 from term insurance. Is that right? Because you can go buy if you're in your 20s or early 30s, you can go buy $1 million of term life insurance for a few $100 a year. But you try to go run a whole life policy on $1 million, you're going to see it's quite a few $1,000s a year. If you've got so many things pulling at your back pocket, and you're not funding your Roth IRA. You're not funding some of those your emergency reserves, because all your money's going to this life insurance policy. So when you're 55 years old, you might be able to take a tax-free loan off of it. Something's askew here. I want you to have the insurance coverage. We love insurance, but I don't want you to do it at all costs, that's the only thing you have. And look, I'm not even against permanent insurance. I've actually worked with, and I've shared this story. I've had clients that we've recommended. We don't sell life insurance, but we've recommended because they had a huge estate tax issue. And I'd imagine that insurance agent that got the business that we referred out to them probably got a $50,000, $60,000 commission check off of it, but it made sense for that client. But that was a very unique situation. The typical American needs to go through the financial order of operations, protect buy term insurance, buy the disability insurance, buy the umbrella coverage for yourself. Don't get sold some very expensive life insurance policy that's going to keep you from putting shoes on the kids' feet, keep you from funding the Roth IRA and getting all the other things funded.